big flashing light takeaway for people listening to this then is that you need to raise a minimum of 60% of the money that you need from your own sources and people you already know before you even think about a crowdfunding campaign.
Yeah, and that's not 60% of your minimum target either.
That's 60% of the total money.
The total money.
Hey guys, it's Matt Haycox here, and we're here for another episode of the Matt Haycox Show, and I'm very excited about today's one. It's going to be a good one because we are talking crowdfunding, very much my space, as you all know, and not just crowdfunding, but quite specifically how to raise money for your business using crowdfunding. And I've got with me a crowdfunding expert and founder of TribeFirst, John Auckland. So John, thanks a lot for being here, buddy.
Yeah, thanks for having me.
Before we start, have you ever talked crowdfunding with a gorilla with a red bra on before?
Yeah, one or two times. I won't name names.
I thought it'd be a first experience. Listen, thanks a lot for being here. Obviously, funding's my day-to-day space anyway, and I always get questions from our audience about how to raise the business, so how to raise money for the business, and quite specifically, how can they crowdfund? And I think what people nowadays think of crowdfunding almost as a guaranteed way to raise money as long as you start crowdfunding, and completely miss that it's that it's a whole journey and a process in itself. So really excited to I guess listen to your thoughts on this and how your business operates with people. But I guess just before we get going, can you talk about exactly how you would describe crowdfunding for people who maybe don't know what the term means?
Yeah, so crowdfunding was born out of the last recession, the 2008 Great Recession, as it's called, and it was a result of banks not lending businesses money anymore. Right? Traditionally, you'd have a business idea, you'd take your proposal into your bank manager, and they'd look at it and they'd go, "Yeah, I like that idea. Here's some money," and off you go. And of course, banks have increasingly, despite being bailed out by us, the public, are increasingly being risk averse to lending to small businesses, and certainly startup business ideas. So it started with debt funding, so peer-to-peer loans, as you well know. Then Kickstarter kicked off in the US, which is a rewards crowdfunding platform. So rewards crowdfunding is quite simply, I'm going to go away and build this. It's going to cost me 50 grand for the tooling, X amount for distribution, X amount for sales. So if you give me the money in advance, I will give you a discount on that product, or I'll give you a special edition that we're only going to release for rewards backers or whatever. Or it's for arts projects that couldn't get off the ground, movies. In fact, actually, the first one to do it, they were all musicians themselves. The guys that started Kickstarter they started it by crowdfunding their next record and their tour. So it actually started with music. There was a bit of sort of touch and go as to whether the SEC, the sort of US regulators, saw it as offering securities, which is obviously heavily regulated in the US. And so they were really, really careful to make sure that they weren't offering any kind of security or loans or anything like that. And so equity crowdfunding is where you actually own shares in a company. So I specialize in equity crowdfunding. That's taken a lot longer to come to market. That sort of came in around 9 years ago with Crowdcube in the UK. And the first one to do it globally, and partly due to the UK, the FCA's sort of slightly more relaxed regulations when it comes to selling financial products. Still lots of regulations, but a bit more relaxed than elsewhere in the world. Or it's more sophisticated, should I say. So it kind of allowed for a framework for an equity crowdfunding platform to operate. So Crowdcube kind of went out there. They weren't authorized or regulated when they first started. Seeders followed soon after and became the first regulated equity crowdfunding platform. And now they've grown into a $1 billion business, or £1 billion business, should I say. The US changed their regulations to allow equity crowdfunding because the UK was getting so far ahead. And so now anyone, whether you're a sophisticated investor or not, from as little as £10, you can invest in businesses you believe in.
Okay.
And you're making a private, very risky early stage investment in these companies. You're doing it mainly because you love the company, you love the idea, or maybe you've got a personal relationship with the founding team. It's very, very risky, but if they do very, very well, you make lots of money.
But just to be clear, then that's on equity type crowdfunding. So I guess a summary for me for the guys watching and listening would be crowdfunding is a generic term. It is raising money that you need from more than one person, i.e. from the crowd. And then within crowdfunding, we've got subcategories. So we've got rewards and donation-based crowdfunding, like you say, like a Kickstarter, or potentially even just giving. These kind of pages. We've got peer-to-peer lending, your funding circles, your assets capitals, your able rates of the space, which is crowdfunding debt, and we then have equity, where you would be investing, as you say, quite often high risk early stage businesses. So all of those would fall under the term of crowdfunding, and I guess it's down to the people to know and pick which is the most relevant one for their business at their stage.
Absolutely, and that's the key, is that the route that you take is the most important decision that you make. People see their equity as quite cheap in the early days, or they don't value it maybe as much as they should. So sometimes they'll go too early before they can justify a valuation that makes sense. Otherwise, they're giving away half their company just to raise money. Conversely, debt you've got to pay back, whereas equity, you're not paying it back. You're just paying out of future profits if you sell the company, which is going to happen 7, 10, maybe longer years down the line. But debt you've got to pay back. So you've got to have the right kind of business where you're making enough money quickly enough to pay back the money and the interest. And then rewards is kind of the one that catches people out the most, I think, because they definitely see it as free money, but it's not free money. You've got to give this product.
You've got to deliver a service.
Yeah, and invariably what you've done is you've discounted it so heavily, you've given all your margin away. So not only have you got to give them a product, you've got to give it away for cheaper than if you would sell it. So why not just do an advanced sales campaign? So rewards crowdfunding actually only works for very, very high margin products. It works if you have a really big engaged community already and you're selling them your next thing, right? And so it's more about just kind of getting cash flow in rather than relying on investors, whatever it might be. And it works for arts projects. So it's actually quite a narrow field. Like, a lot of people try rewards crowdfunding apps. It just doesn't work. It never works. People want something special that they can hold in their hand.
So, and I guess talking about an engaged community is probably a nice segue into talking about your business and what you do for business owners and borrowers, equity raisers. And again, I can tell you very much from my experience of dealing with people looking to raise money for the business. People feel, and we're talking specifically equity here, that they take their business to an equity fundraising platform, a Crowdcube, a Seeders, whatever that may be. And they feel, we list it, and in 30 days' time, it'll have filled with a load of money, and we'll be taking our check to the bank. And 99 times out of 100, this very much isn't the case. And again, I'm talking quite generally here, which is to say that I believe that the businesses need to look at these platforms as simply that, a platform, a method of being able to raise money, a regulatory compliant method of being able to raise money, but certainly not a guarantee of actually any investors coming to the plate and putting any money in. And I was talk very much to my audience about the fact that before you start a fundraiser, a crowdfunding campaign is kind of called that because it's a campaign. This is something you need to put in place 6, 12, potentially even more months in advance to actually get ready for that fundraising. So I guess that kind of segues us into what you do and how your business and role was created.
Yeah. So yeah, as you say, first of all, anytime I'm going to talk about crowdfunding on this interview, it is going to be about equity only.
Okay.
We're specialist equity crowdfunding. So I'll dial it back a bit to when I first set TribeFirst up. I was a director at a through the line marketing advertising campaign. So we work companies, should I say, we did big campaigns for blue chip companies, the BTs, Chevrolets, these kind of big brands that would have some kind of communications challenge. And we would go in and would fix it with a really interesting creative campaign that would be videos, PR, just kind of cross the a broad spectrum of different comms sort of channels. And we were asked by a startup to cover their their intern had left 6 months into their internship. So we were asked by this startup to cover the final 6 months until the intern cycle started again. And I kind of looked into it. This is a very well-funded Rocket Internet-backed startup. And for those of you that don't know Rocket Internet, they're like a German-based sort of VC incubator. And so they throw a lot of money at really, really fast-growing, high potential startups. And so a very well-funded startup was using interns to run its marketing function, which I just found utterly bizarre. And so, of course, this intern didn't really know an awful lot about marketing at all. And so they would do stuff like stick a puppy photo on Facebook because it got loads of likes. Or they'd take a photograph of a lottery ticket they'd bought, and anyone that liked it or shared it, if they won, they'd get a share of the winnings. Okay. Right? Just real clickbaity, horrible stuff. And of course, all they got is a sort of time-rich, financially poor audience. And their demographic was actually time poor, but financially rich. And you might be forgiven for thinking this startup's like some kind of puppy lottery company, right? It's actually a $2.5 billion market cap company now that does grocery home deliveries, HelloFresh.
Okay.
And so that just kind of made me realize that there's a fundamental problem in the way that startups approach marketing communications, and they kind of do it haphazardly. They bring in interns. It's an afterthought. And of course, many a good startup has failed because they've not been able to get the exposure they need to actually take their product to market. And so this was a problem in marketing and startups generally. And when crowdfunding came along, what I recognized is that crowdfunding, it is disrupting the startup fundraising markets, but what it's disrupting more is the startup marketing market, right? Because you're getting all these people that buy into your idea and early adopters, people that are going to go out there and be brand evangelists are paying to be a part of your club, paying to be associated to your brand in the early days, which is an insane idea. 10 years ago, if you'd said in the pub that's what's going to happen, someone's going to pay to be a part of my club, and in the hope that maybe in 7 years, 10 years time, they get a bit of money for it, people would have just laughed you out of the room. So I think what's happening is, millennials, Gen Z, generally speaking, people want to have deeper relationships with the brands they love, right? And so that's what's happening with crowdfunding is, it is democratizing finance. It is allowing people to get in on the big campaigns, the what 3 words, the money boxes, these big companies that are probably going to go on and do massive IPOs in the future, the Monzos, the Revoluts. It is allowing people to still get in where traditionally only big VCs would have made money from that. So it is doing that. But the bigger thing it's doing is it's allowing, people that love these brands to create a deeper relationship with them in the early days.
I mean, it's interesting you say that, and I may be making a sweeping generalisation there, but I personally don't feel I am, which is to say that I believe that most of the people investing in a lot of these, funky-looking brand, but early stage businesses, have to be doing it more from an emotional attachment than financial sense. Because if you look at the valuations that these companies, these non-existent companies are raising money off, there is no way in the world that they'd be able to raise that money from professional investors, from venture capital, from people who are not emotionally attached to that business in some way, shape, or form. I mean, it literally, some of the valuations these guys get. It's literally like getting a gift from mom and dad to set your business up. I guess someone like Brewdog would be a fantastic example of how they've done this phenomenal job of building this incredibly loyal base of both investors and customers in one who buy their premium product at a premium price and have the pleasure of investing in that business at an utterly insane valuation. And yes, you say that there's some of these opportunities that ultimately may go into IPOs, but I'm sure if those businesses were looked at purely on the financial sense, the financial economics, with no emotional attachment to those whatsoever, they would not make sense as just a pure investment play. I mean, this, and I'm hammering home this point, but I guess I'm hammering it home for the people listening and watching to this. So I guess this is where you step in from a marketing perspective. This is why it's so important, to get that brand right, to get that engagement right from day one, because most of these people investing in your business, certainly investing at the valuations that they may be trying to get, are not doing so because they think they're going to turn 100 quid into 370 quid, in a 4-year time frame and on a risk curve of whatever. They're doing it because they want to go and tell their mates that they've invested in this business, or they want to feel part of the journey. And this is very much, marketing dressed as finance, as opposed to finance with a bit of marketing.
Absolutely. And Brewdog's a great example, right? Brewdog is not a beer company, contrary to popular belief. They're a PR company.
Yeah.
They're a very, very good PR company. That sells, and James and the others, if you're watching this, don't. It's good beer, but it's not the best beer in the world. It's not like worth paying so much more for. You're not paying for the beer; you're paying for the experience of being a BrewDog punk. They've got over 100,000 investors. These 100,000 people, they buy BrewDog. I'm a BrewDog investor. I buy BrewDog if it's there because I'm an investor. Why would I buy anything else? And I tell my mates about it, so then they buy it as well, and they drink it, and it's good. It's good beer, so they drink it as well.
But it cuts both ways as well, insofar as they've got 100,000 investors, which is effectively guaranteeing, as well as raising that money from the 100,000 people, they're guaranteeing themselves 100,000 customers as well,
exactly.
And vice versa, in that they've got 100,000 minimum customers who are there for the next round of investment at some batty valuation.
Absolutely, and when they probably eventually IPO, which I'm sure they will do, they may never need to, but I'm sure they will do some stage in the future. That IPO is going to go crazy because they've got that solid base of investors. So
and they get a baseball cap, even if they don't make any money.
Well, exactly.
They do get a BrewDog baseball cap.
And they have literally written the book on crowdfunding. These guys. There's a book. It's a very good book. I've read it myself and got a lot of ideas from it. And they just do crazy stuff like
Business for Punks.
Yes,
Yeah.
I think they've got another book, okay. but that's specifically about how they use leverage crowdfunding. And so, they did crazy stuff like drive a tank through London. They gave away, in their last round, they gave £1 million worth of shares via a lottery. So if you bought shares in the round, you might win £1 million worth of shares. And just and constantly doing like the first ever beer hotel where you could take a bath in beer. They did the BrewDog Airlines. They're just constantly innovating from a kind of PR perspective of ways they can raise equity, and then off the back of raising equity, then sell some beer.
Yeah.
To the point where they achieved over £1 billion valuation on, I think they were on like 90 million annual turnover at the stage, which is just insane for a beer company.
And obviously we talk about some very extreme examples of marketing there, on a couple of very high profile businesses. But, is this indicative of what business owners need to be doing if they want to be raising money in the crowdfunding space? Do they need to be driving a tank through London, or does this work on a dumbed down basis?
Yeah, and that's exactly the point. Most of the time, it's working on a much lower key basis. So sometimes it's good to show the extreme example of show the art of the possible, so to speak. But the reality is, most people aren't doing any marketing at all. So to your point from earlier, if you just stick your campaign on the platform, it will be compliant, it would tick all the boxes, but you're not going to get any support from the platforms on actually how to make your campaign ready or your brand ready for crowdfunding or fundraising ready, we call it.
Sorry to cut you off in your flow, but out of interest, I mean, I guess maybe something nowadays they do, but I mean, do platforms like Crowdcube and Seeders, not have people like you in house to lend to their prospective borrowers, or do they recommend people like you to go and do it for them? I mean, to me, it just seems an obvious. If I had an equity raising crowdfunding platform, it's in my best interest, to help our borrowers do the absolute best possible job of raising money. I mean, how involved do they get?
Yeah, so the answer is depends on the platform, and they've tried bringing it in house. Like Crowdcube specifically, at one stage they tried bringing it in house as much as possible. They felt that was their job, but of course they ended up having a massive headcount, and not every single campaign needs the same amount of support. So if a platform is trying to be a service company at the same time, invariably it does both quite badly. You're neither a good service company or a good platform. And so I think they realized that a few years ago. I recognized that was probably going to happen around the time when I set TribeFirst up, when I was doing all the risk assessment around setting the company up. I just thought they've got to be a platform. They're never going to make any money unless they become a marketplace and platform as big as possible. That's where they make their money, not being a service company. So they will need people like us to fill that gap, that and sort of plug that sort of needs gap that the companies themselves might not have. Because you'll have these big companies, the what 3 words of the world and the money boxes of the world. They've got sophisticated marketing functions. They don't need so much support. They don't know how to apply it in a crowdfunding context, but because of the size of the raise and how much money they're going to earn from it, Crowdcube will go on and they will provide, additional support to those companies. But they can't do that to someone that's raising 200 grand. Both those companies raised over 7 million quid. Well, you're raising 200 grand, that's not scalable. So they have almost like an elite team, I guess, that provides that hand-on support for the very big companies. But everyone else now, Crowdcube specifically relies on partners, like us. Sometimes they just need a video. Sometimes they need the full service, which is when they come to us. Sometimes they just need some marketing support, or some freelancers. And so there's various other people in Crowdcube's partner network that will provide that service. Seeders is slightly different. So Seeders sees itself as a marketing platform in the sense of a financial promotion platform. So they actually charge you for various marketing services. So they will charge you for an email, like a dedicated email shop, for example, or they'll charge you for social media advertising or pay-per-click or whatever. So there's a bunch of services that they charge you for, and you get some support with that, but they're still only providing marketing services for how to get the most out of their platform. They're still not doing stuff that we know is really important about, actually, you've got to promote the company during the race. So our key USP really is that by running a PR and marketing campaign on the company, so we do thought leadership type stuff on the founders. We fix their brand if their brand's not quite right. We get them into the media, we get them speaking on podcasts and things like this, right? And getting the word out there. And that builds investor confidence that, there's a buzz around this company. And sometimes we do the big, interesting and exciting campaigns. We've never driven a tank through London, but, sometimes we get to do some interesting things. And that's quite effective. But ultimately, we're doing it about the company itself, which then raises awareness of the company.
As opposed to that specific investment
opportunity. And so Crowdcube clearly couldn't do that. Seeders clearly couldn't do that on every single company.
But when you're raising awareness for that business, are you putting in the email signature, we're raising on Crowdcube? So
exactly,
it's even though you're not actually talking about the campaign in itself, you're seeding people for the fact that, hey, we're here, we're a big company, and we're doing good things, and by the way, we're going to need some money at some point, so remember us.
Yeah, exactly. So again, there's kind of a bunch of basic things that you do on every single campaign. The email signature thing is a great thing. Founders just don't think about doing it because it's not what they do on a regular basis. We've helped over 75 companies now over 80 companies raise in excess of 42 million pounds, I think. So you learn quite a lot. Like, we learned crowdfunding pretty quick. We didn't know crowdfunding when we first did it. Our first campaign was for a former Formula One team.
Okay.
It was called Project Brabham. It was the biggest sports crowdfunding campaign of all time at the time. Raised 300 grand off an idea alone, and we just treated it like a normal campaign. So we made a load of mistakes with the crowdfunding side of things, but because the campaign was so effective, it still raised the money. But over the years, we kind of just, and a few failures. We haven't had many. I think we've only had about 8 failures in 4.5 years.
And if we look at those failures as as something to learn lessons from, going back on them now, what is there anything you could have done different to make them a success?
Absolutely. I mean, the biggest realization to me was that the crowd, so this kind of indiscriminate group of people that are apparently out there just waiting to stick their money into good ideas, they're actually more risk averse than you might think. Obviously, in context, right? They're all risky in their own way if you're comparing them to other kind of asset classes.
Why we need to sell them on emotion as opposed to sell them on finance.
And so they've got no emotional connection to you at the moment, and they've got 30 or 40 campaigns at any given time they can look into at Crowdcube and Seeders. Why do they look at yours? It's because you do a really good job of drawing them in at the first place. So, very succinct message. Visually, your image, starts to create that emotional connection. So having very, very good design that quickly sort of disseminates and summarizes what, why they should care about you is quite important. And there's a bunch of other things you need to do to build that emotional connection, but ultimately they don't know you. So that's quite hard to build that connection with someone that you don't know. If you have an established brand, so, if you are Monzo or Revolut or a Moneybox or someone that has a lot of customers, that emotional connection is already there. We work with people that don't have that emotional connection but need to build it. All right, that's our kind of specialist area. And so there's an order to doing things. You have to get friends and family in first. Okay, they are, because even investors, because it's so risky, they generally don't tend to go first unless you happen to know an angel investor and get them on board. So friends and family kind of go first. The investor comes on and validates the valuation. Then your community, your wider community, your customers then come on. Then the crowd comes on. And it took us 4 or 5 failed campaigns before we recognised that.
And what percentage of the overall raise do you see that the crowd actually is?
Between 20 and 40% of a good campaign. Okay. Sometimes as little as 10%.
As little as 10. Okay, so I guess, a big flashing light takeaway for people listening to this then is that you need to raise a minimum of 60% of the money that you need from your own sources and people you already know before you even think about a crowdfunding campaign.
Yeah, and that's not 60% of your minimum target either.
That's 60% of the total money.
The total money, because what people tend to do on crowdfunding, because you need to, and there's a good reason for it, but I'll go on to explain why. But you need to launch probably on 80% plus. It used to be when we first started, 20% was enough
for getting the momentum.
Yeah, getting momentum, and that's of your minimum target. So let's say you want to raise 500 grand. What you would do is you'd set your target, and you've got like say 150 already lined up. You'd set your 200 grand. You'd set your target. So you've only got 50k left to go. So you're on about 75%, knowing that kind of you go out there and speak to a few people, you probably get it over to 80% fairly confidently by the time you launch. That you've got to do that as a bare minimum, and that's probably going to surprise an awful lot of people because it took about 2 years of surprise before we finally realised how you've got to do it. And the platforms now kind of come on board and saying the same things now. They used to just say get as much volume on the platforms as possible, and they will just draw people in, and then they'll invest in this campaign and other campaigns. So they used to be pretty indiscriminate about who went on. Now they're being a lot more selective because they realise actually they need to be a curated marketplace. There needs to be good deals on there. Otherwise, actually, investors won't come on. And so what that's led to is this kind of conditioning of your average investor that looks on Crowdkeeper Seeders and sees a campaign on over 80% and thinks, that's fine, I'll go and have a look at it. If it's under that, what's wrong with it?
Yeah.
And it's the empty restaurant syndrome, right? You could have a restaurant that is in a Michelin guide and it's a Friday night and you walk up to the window and you look inside and it's empty, absolutely dead. What do? You walk away. You go to the one next door that's scored three stars on TripAdvisor, but is absolutely packed. And it's because you just think, what's wrong? Has the chef changed and I don't know about it, or they've just been caught for having cockroaches or something. Do you see what I mean? Like there's safety in numbers, and crowdfunding is definitely.
Well, I'd say I'm probably very much off the back of what you're saying, from a perception perspective, as opposed to the fact that there's just so many more people interested in investing. I mean, if you go on, Crowdcube as an example nowadays. When I remember looking at that site, say 12, 18 months ago, and if there was 30 businesses, listed raising money, there'd be 1 or 2 that have probably raised the money or overfunded. There'd be 10 that are on the way and 20 that are nowhere near. If you go on crowdfunding now, so if you go on Crowdcube now, I guarantee you 90% of the businesses on there are showing as overfunded or already. And you think, well, how the fuck can they be overfunded? They've only listed yesterday. Like, the reality is it's just setting it up for the perception of, okay, you're saying you want to raise 200 grand, but really you need to raise 800 grand. But you're saying you want to raise 200, you're already bringing in 210 grand from your friends and family, and and all the marketing pizzazz that goes with it, and then praying that'll then lift you up to the secret number that you're not declaring of how much you actually are prepared to overfund.
Yeah, and so crowdfunding has, don't get me wrong, it's had quite a lot of criticism for this because you're just kind of gearing the system. But I just don't think that's true, because what's actually happening is, the investors that you don't know that haven't built that emotional connection with you, of course, they're always going to be the last ones to come on, right? So it's still worth doing just as a place to consolidate your own network, right? And you might think that you're paying quite a lot of money to Crowdcube or seeders and people like us, you know, cost of raising capital can be 10% plus by the time you've paid all the people that are going to help you get there. But it's still worth doing because, you know, even your friends and family, they'll say they're going to do it, but it's hard. It's quite scary for them. And having the brand recognition of these kind of well-known companies that a lot of people are trusting in to put their money into gives them more confidence. They invest slightly more than they might have done if you just asked them to directly transfer it into a bank account. It gives them that reassurance that there's a sort of third party there validating it.
And I think as well, you know, if we're talking of ways to game the system, so to speak, you know, for people listening to this or watching this, you know, anyone who's put off by the fact that you think, well, you know, I don't want to pay 10% cost of fundraising. You know, one of the things we were saying at the beginning of this is that raising money through crowdfunding can allow you to raise off absolutely insane valuations because you're selling to people on emotional attachment as opposed to financial sense. So effectively, any costs of fundraising, you want to be looking at building into the cost of the capital you're raising anyway. So if you want to raise £1 million, well, just set out to raise 1.2,
exactly,
and cover those costs because the actual number of shares you're giving away and the valuation is almost irrelevant. You know, we're not selling these to a sophisticated investor to a private equity house who's going to due diligence a living daylights out of the valuation. We're selling this on the dream of being on the journey.
Yeah, and so on the valuation point, I don't necessarily think that these companies are overvalued. I think there's a bit of a bubble. I think there is a bit of a bubble, but I don't think it's as big a bubble as a lot of people are saying. So I think what this comes from is that I think that private investors...
I'm a skeptical lender.
Well, I think private investors have had a really good deal for quite a long time. And of course, it works both ways. If you have a founder that's after 4 or 5 rounds is actually a minority shareholder in their own business, they can be disincentivized. And so I genuinely believe a lot of good businesses have failed historically that could have been really high growth businesses that were restricted from being able to raise as much capital as they wanted to because they were constantly playing that battle between, I want to raise more, but I don't want to give my company away. So what crowdfunding has allowed is for companies to be more aggressive and for the European fundraising market to be closer to Silicon Valley in terms of how aggressive it can be with growth. And historically, the UK private equity venture capital market, we've been much more risk averse. And I think to our detriment. Why is it all the big unicorns have come out of Silicon Valley and not out of London? And I think that's been the problem. That has changed. And I think there is still a systemic problem where we're selling companies too early. So they're not reaching unicorn status before they kind of get, assets stripped for their IP by one of the big tech giants over in the States. I think there would be more unicorns, or there would have been more unicorns in the UK, had crowdfunding been here 10 years earlier for the kind of .com, boom bust back in the day. Let's not forget that back in, sort of prior to the early noughties, it used to cost you about 30% cost of raising capital back then because, you had these kind of really aggressive brokers going out there raising tons of money. It was just this crazy marketplace. It was a proper bubble. And a lot of companies went bust, but equally, a lot of the massive giants that we know today were born out of that era.
So let's talk about some practical tips then for people who are looking to potentially use crowdfunding for the business, or maybe even halfway through a campaign now, and they wish they'd watched this interview 6 months ago, before things had stagnated. What are the kind of top 3, 5, 10, however many tips that people need to be doing if they're going to go and raise money from crowdfunding?
Yeah, so I think that order thing is quite important. So make sure that you go friends and family first, a lead investor or angel investors, or just a big investor second. And I mean chronologically timing the money going on the platform as well.
Okay.
So the lead investor kind of sees that they're not the first one going. There's a bit of money on there. They then go second. And it's quite a lot of money on there, 60-70%. I
mean, presumably with your lead investor or with your friends and family, you've had a transparent conversation.
You're telling
about
them
how
that's
the
their
game's
role.
played.
Exactly, yeah, this is their role. But I've known some lead investors to go to be spooked because they go first as well. So it is still important to get the friends and family on there just to make it that little bit less scary. Then you put it out to your community. You put it out to your community and you say, I'm giving you first priority on this. It could overfund before I take it to public.
And forgive my interruptions, but what by your community? What do you mean? The people in my Rolodex, as in, or my existing customer base, my audience?
Yeah, everyone that you ever emailed on your email database, but also on your personal email. Old school friends always come out. All the entrepreneurs we work with say that they're surprised that someone from school invested. Every single campaign. It's amazing. So school alumni. Customers, of course, you might have 3,000, 4,000 customers, and I've been amazed at how many times an entrepreneur hasn't wanted to go out to the customer base for the fear of perception of, I'm raising money. Does that mean that I'm an inferior product or something, or weak? Yeah, it's madness.
Well, just going off on a slight tangent, I have this conversation quite often with, let's say, celeb pals of mine, or people who've got a public persona where they're wanting to raise money for a particular business project, and my immediate reaction is, right, we've got to be getting you crowdfunding, because we're going to be able to leverage your brand. We're going to be able to raise money probably on a better valuation for you than you would, and potentially even quicker. And the reaction's always immediate, no, I don't want people to know I'm raising money. They need to think that I'm strong or I'm wealthy or whatever. But it's such a fallacy. It's absolute garbage. I mean, every business person, whether it's the first rodeo, or whether it's a multi-billionaire, looking to buy another multi-billion-pound business, everybody has to raise funds.
Yeah, I mean, everyone assumes that Richard Branson sits there on a pile of his billion, should I say, and every time he starts up a new business, he just kind of dips into it.
Whereas
it doesn't work that way.
The reality is
not liquid
more often than not the exact opposite. In that the more money you've got, the less you'll use your own, and the more you'll borrow, because the more money you're making, the more preferential terms you're getting anyway.
Well, exactly. I mean, it's but even kind of ignoring the sort of the fact that you have more leverage because you are wealthier. The fact is, most wealthy people, their wealth is tied up in illiquid assets. You can't just. And this is true whether you're a celebrity or not. And also, most people know that. The public generally does tend to know that. Not everyone, but enough people. And so we've done it before for celebrities, and when they've not gone out to their own network, campaigns have just failed. In fact, my next meeting is with a very well-known sports person, I'm fairly confident that he's going to go out, all guns blazing and be the public face of the campaign and leverage his network, but. We're not going to take it on unless he does. And that works whether you're a celebrity or whether you are, a complete unknown, right? People still get this fear of going out, even to their friends and family. If you have that fear, if that fear is going to come up at any stage, don't crowdfund. And in fact, actually, you asked me about failures earlier. Out of the 8 failures I think we've had, all but one of them had an element of that founder didn't want to speak to absolutely everyone. There was one of their sort of audiences that they should have gone and spoken to that they didn't. And really annoyingly, our first ever failure, and it kills me to this day, he was nervous about it, but with a bit of coaching, he probably would have done it. But yeah, he stuck out a post on his Facebook. Then was at a party a couple of weeks after his campaign had failed. And one of his mates came up to him and went, "Oh, how do I invest? Tell me how, I saw that post. I've been meaning to do it." He went, "Oh, campaign failed a couple of weeks ago." He went, "Mate, I was going to put 100 grand in." And that 100 grand was easily the difference between success or failure for him. And he just didn't think that his friends had that sort of money, let alone would be willing to invest it into him. So that story kind of stuck with me. And so now part of our vetting process is trying to understand, is that founder, are they all in?
How big's your audience?
Yeah, exactly. Yeah.
Okay.
So that's probably the biggest bit of advice you're going to get today, I think. But aside from that, basics, email signature, quick win there. PR, just in some way get out there speaking to your trade media. If you work in a particular sector, make sure that one of those trade media is talking about you. You've been interviewed with them, or you've written a guest article. It's really easy. Write an article on a subject that is relevant to that audience and offer them the article. And you can find their magazines and newspapers. They always have the contact details of the journalist. And just offer it to them. Here you go, I've written this. Would you like to publish it? You make it so easy for them to just say, yeah, all right. Or I wanted a slightly different article. Can you write this? And you go away and write or whatever. But just getting one or two bits of coverage there's this kind of thought leadership, content marketing type content out there in your trade media is the thing that normally tips the balance with the investors that don't know you. Because people invariably, they're investing in the team more so than the idea. And if you are relatively unknown and not being talked about and you hide behind your campaign, people won't invest. So you have to be the face of your campaign. You have to be out there speaking. You have to be confident. You have to be on video quite a lot for the actual campaign itself. You have to be out there meeting investors and building confidence with them.
So what if you just have to accept you are a business owner that is never going to be that public face? I mean, can you make it work by nominating someone else as the face of the business?
Yeah, that's what you got to do. Whether it's an influencer in your sector that you bring on board, give them 10% of the company. There will be no company unless, especially modern day brands, there will be no company unless you have someone that's kind of there and being the face of it. It's far easier to build an emotional connection with a person than it is
I'm sure,
an entity.
Perfect. Well, that's how people can do it themselves. If they don't want to do it themselves, how do they find you? And now's your chance to give yourself a plug.
Excellent. Shameless plug. So TribeFirst.co.uk, or just follow me on
FIRST.
FIRST, yeah. Or you can find me on Twitter or LinkedIn. I'm quite active on LinkedIn. At John Auckland, like New Zealand, AUCKLAND. So we support companies in two ways. You effectively outsource your campaign to us as much as you can. Obviously, there's certain legal and compliance things we can't do, and you still need to speak to investors. But we will do the kind of the grunt work, if you will, and the marketing PR that sits around all your campaign. So we only do that a select few. About 5% of the companies that apply to work with us, we offer this to. We also have an accelerator product, which we do with a much higher percentage. We'll still tell you if we think it's not right for you, but we're a lot less sort of selective with our accelerator product. We have done that with Virgin Startup in the past, so it was called CrowdBoost. We're hoping to start CrowdBoost back up again. It was always a face-to-face accelerator. We're hoping to start that back up again in the future, but for now we're running it TribeFirst branded only as a kind of virtual online accelerator. But I'll keep my social channels updated as and when that changes. And the other interesting thing we're doing at the moment, we realize about 80% of the companies that we support have some kind of ESG, so environmental, social governance agenda. So that they're saving the environment, saving the planet, clearing plastics out of the ocean, or whatever it might be.
Saving the gorillas.
Saving the gorillas, indeed. So we wanted to kind of make that 100%. We're not too far off being able to do that. So we're in the process of raising a fund, a 5 million fund. It's already about 40% subscribed. It just means that we can be our own lead investors.
Okay.
So if there's any sort of ESG type companies out there, do speak to us, because we're going to be starting to deploy those funds hopefully early in the new year. And any investors as well that want to invest into ESG companies. So
to be clear then on that, you would still run the crowdfunding campaign, etc., for them, because you still want to get the money from the crowd, get the money from the friends and family, but you will put that, whatever the figure is, 10%, 20, 30%, lead investor chunk, that would come from your fund. Exactly.
A lot of the really, really interesting, potentially world-changing ideas that we were seeing would scare off that lead investor. So they were struggling to find the lead investor. We're working with a company at the moment. They are going to replace plastic bags with these biopolymer plastic bags that use a really clever bit of technology that means they're made out of natural plastics that biodegrade. They break down perfectly fine. Couldn't find a lead investor. Loads of friends and family, quite a big community of people that are interested. So that just solves this problem. It allows us to be able to invest in people like that quite easily.
Perfect. Well, John, thanks a lot for being here. It's like I say, super interesting topic that's close to my heart, and I know it's we've answered many questions that my audience ask every day, and I think mistakes that I see many businesses make every day in my day-to-day life as well. So thanks a lot for being here again. And guys who've been watching or listening, if you like this, make sure you press like. Also, if you like this, press subscribe as well, and you get to see lots more videos like this, lots more great guests like John, inspirational business people, celebrities, and everything in between. So I'll see you again next time.